What's up, everyone, and welcome back to today's episode where we're going to talk about the 3 best tips to forecasting and growing your small business through robust financial management. And topically, we're going to also just touch on Silicon Valley Bank and how that bankruptcy purely was due to poor forecasting and cash flow management. So, Silicon Valley Bank was one of the top 20 banks in the US. And over the weekend, they collapsed in dramatic fashion because they mismanaged their cash flow. Essentially, what the bank has done is it had gone and secured investment or bonds or treasuries from the US that paid them a very low interest rate in a period where COVID and interest rates were low. And they locked that in for 10 years. And they were using that income to fund their business operations and pay deposit holders and so forth. Now, obviously, with rising interest rates, what happened was the deposit holders, so your term deposits return went up. So your term deposit was asking 4%, so they had to pay their clients 4%, but they were only earning 1.82%. So essentially, there was a mismanagement and a mistiming in cash flow that ultimately brought them undone in spectacular fashion. Simply less was coming in to what was needing to be paid out. So for a small business, this is one of the primary reasons where you essentially go bankrupt. So let's talk about our 3 tips to ensuring you are not the next Silicon Valley Bank. So number 1, the first tip to ensuring forecasting done correctly is starting with a robust level of data. Forecasting is essentially using historical data and extrapolating that out into the future to try and build out a map of what may or may not happen. Now, to do that, if you're starting with wrong information, your assumptions are fundamentally flawed. And that is a massive, massive issue. It's almost like getting dropped off in the wilderness with a map, but your starting point on the map is different to where you actually are. And you're just walking in no man's land, thinking your map is true and correct, which it is. You've just started at the wrong point. So it's really important to think about your bookkeeping, your payroll, your accounting, your system. If it's Xero or if it's Maya, whatever your accounting software is, make sure data is incorrect, inputted correctly. Your chart of accounts, your transactions are reconciled. So when you look at a summary, which is generally your profit and loss and balance sheet, you can gauge the numbers in there accurately reflect your business's performance to date. Now, when you have that base, it gives you 2 things: a great insight into the journey to get you today, and also a great space to feel comfortable that the numbers that you're trying to project out into the future are starting correctly. So number 2, when you finally have your base of information correctly, it's about forecasting. And forecasting is both mathematical science and an art. No one really knows what the future holds for any business, let alone any life. What we're trying to do is build out multiple scenarios. And we always say, have 3. Have a downside scenario where the world might be not going so well. So your revenue's going down, your expenses are going up, probably what's happening right now, and forecast what happens to your cash flow. So where does your cash balance end? Do you need to have debt? Do you need to raise money? Understanding that downside scenario is really important. Understanding a stable scenario. So if things stay stable as they are and a few assumptions happen, maybe I hire someone or I buy a truck or van and my profit margins increase, what will generally happen to my business? So a nice base case, we call that. And the third one, which is the main one, which is probably your entrepreneurial spirit, is your kind of positive case, which is I'm going to hire 10 staff. I might buy a factory. I might import more stock. Whatever it might be, you want to have these 3 scenarios, your positive, your base, and your downside, to really give you a clear indication as the guardrails in where your business is going, from the worst case to the best case. And you want to accurately depict each lever. So if I hire the staff member, in 3 months, they'll be profitable. If I buy more inventory, I'll have more costs, but I'll be able to ship my product quicker. You want to get down to the nitty gritty of your forecast, because that's what's going to accelerate your decision making. That's what's going to give you comfort. That's also what's going to tell you, oh gosh, if I do too many things, maybe I run out of cash, which is a big problem in small business. So number 1 was really about accurate data, knowing your current profit and loss and what it looks like. Number 2 is building these layers of scenarios on top. The third most important thing around forecasting is the method you're doing it. So are you doing it via an Excel or are you doing it through a software? Either way is fine, but you want to have a method that's easy to use, easy to maintain, not this cumbersome, massive spreadsheet that you never look at ever again. We always suggest something like an Excel for a very simple business owner that just has 12 months, very basic line items like revenue, costs, profit. And if you can understand those basic items, you're starting really, really well. And as your business grows and maybe have more complexity, you really start adding cost of goods and you're adding wage expenses and all this complexity. And you're potentially at the stage where you need to get someone in to kind of do some financial modeling, or you're using a software tool like Futurely, Fathom, all these kind of apps that sit on top of your accounting software, which is Xero or MyOb, generally we suggest. You really want to build out an easy way for you to look at your forecast. The last one, number 4, you can have all this fancy stuff. We talked about having accurate data, having base case, downside case, positive case, having a really nice system. But that's kind of all pointless if you don't turn up every day and actively look at your forecast, look at your cash balance, understand, did you meet budget? Did you not meet budget? Having a process to review your forecast and go, oh gosh, things have changed. Wage costs have increased. I've got 10 new amazing clients. My profit looks different and I need to hire. You need to have this cycle. It's called a rhythm. You need to have a rhythm where maybe it's monthly, you kind of with your accountant, close your books, get a profit, check it against your forecast, update your forecast. Next month, close the books, check your profit, update the forecast. And that monthly cycle or rhythm is imperative to take you from small to medium, medium to large, because large businesses, profitable businesses, intimately understand what the future holds. And it's really critical that you have a process on top of accurate data, which is the first one, a great scenario base, which is the second one, and a great software suite to help you get there. So that's it. If you're out there trying to grow your business, we think when you get to a sustainability stage, forecasting is really important, and doing it properly so you just don't end up like these big Silicon Valley banks that just explode on the weekend. And it's hard to understand that if they can get it wrong, how easy it can be for a small business to get it wrong, but it can. And we want to help you stop doing that. So reach out if you have any questions. Forecasting is a minefield, so please put your comments, hit the like, subscribe, let us know how we can help. We look forward to doing more of these. Thanks again. Bye.